Welcome back to the Deep Dive, where we, really get into the nitty-gritty of these earnings calls and try to make sense of them for you.
Yeah.
Today, we are talking about Maravai LifeSciences. Pretty key player, I would say, in the biotech and life sciences tools arena.
Yeah, for sure. Big name in the space.
Right.
And, lots to unpack here as always. So let's jump right into it.
Absolutely. So to kick things off, I think it's worth taking a look at the high-level numbers. They reported fourth quarter revenues of $57 million, right there in the middle of what they expected.
Which is good, I guess.
Yeah, meeting expectations, always a decent place to start. And for the full year 2024, they brought in $259 million. Again, kind of right smack dab in the middle of their projected range.
Okay, so top line numbers looking pretty good, pretty much what they thought it was going to be. So now let's get into the weeds a little bit and see what's really driving these numbers.
Sounds good to me. Their Biologics Safety Testing segment, we'll call that BST for short, that brought in $15 million in Q4 and $63 million for the year. So, looks like a pretty consistent performance there.
Yeah, definitely. I mean, BST has been a steady performer for them. And then switching over to the other side of the business, you've got their nucleic acid production segment, the NAP segment. They generated $42 million in Q4. And a big chunk of that, like about $14 million, came from those high volume CleanCap sales. Those are the sales going to customers who already have those commercialized vaccines out on the market.
Makes sense?
Yeah, so that, it kind of highlights that there's still good demand out there for that mRNA capping technology.
For sure. So really their success is tied to their customer success too.
Absolutely.
Now for the full year, that NAP segment pulled in a total of $196 million. And if you really want to get into the details, $130 million of that was from that base NAP business, and then the other $66 million was all attributed to those high volume CleanCap revenues.
Exactly.
So kind of an interesting split there.
Yeah, I mean, you've got the base business, which is, it's that more consistent revenue stream, but then you've got those high volume sales, which can be a little bit, up and down, right?
Absolutely, absolutely. Okay, so that's the revenue picture. Now, let's talk about, the bottom line here. Maravai reported a GAAP net loss before non-controlling interests of $46 million for Q4 2024.
All right.
So, still a loss, but it's a pretty significant improvement if you compare it to the $110 million loss from the same period last year.
Yeah, no, definitely heading in the right direction there.
It is. It is. Yeah. So at least there's maybe some light at the end of the tunnel in terms of managing those expenses.
Definitely.
But. Yeah. When you zoom out and look at the full year picture, the GAAP net loss before those non-controlling interests was actually $260 million.
Okay.
Which, I mean, that's higher than the $138 million loss they had in 2023.
Yeah.
So a little bit of a disconnect there, right, between the quarter and the full year.
Right. And that's where, the adjusted EBITDA, I think, starts to give us a little bit of a better picture of what's going on operationally, right? It takes out some of those non-cash items and some of the one-time things that can really skew the numbers.
Okay. Yeah. No, that makes sense. So what was their adjusted EBITDA looking like?
So for Q4 2024, the adjusted EBITDA was actually negative $1 million. So that's a pretty big swing from that positive $21 million they reported in Q4 of 2023. And it's actually also below what they were expecting, which, not great. But it does kind of point to some of those, maybe some challenges they're facing when it comes to operational efficiency and profitability, even if, revenue is kind of in line.
So what are some of those things that might be, dragging down that adjusted EBITDA?
Well, they had some lower product gross margins, plus their product mix wasn't quite as favorable. They didn't sell as much of that higher margin GMP CleanCap product.
Makes sense.
Yeah. Then on top of that, they had some, just some variances in their manufacturing process. Nothing too crazy, but still something to keep an eye on. And then they also had to take a non-cash inventory reserve at their AlphaZyme subsidiary. And then to add insult to injury, they had a $1.3 million bad debt expense.
Oh.
Yeah. Ouch, right. Apparently, one of their NAP customers, they went belly up. They had an unsuccessful preclinical trial and just stopped operations altogether.
Well, that'll do it.
It happens. It happens. And then, the cherry on top, they had higher external fees too. Things like legal costs for protecting their trade secrets and those increased audit and professional fees that always pop up around year end.
Yeah. That makes sense.
Yeah.
So all those things together really kind of put a dent in their profitability for the quarter.
Yeah, for sure.
Okay. But when you look at the full year, their adjusted EBITDA landed at $36 million.
Yeah.
That's a margin of 14%. Not terrible.
Not bad.
Yeah, great, but not terrible.
Yeah.
So, I guess the question is, how strong is their financial position overall at this point?
Well, they ended 2024 with $322 million in cash and $300 million in long-term debt. But here's the interesting part. In December 2024, they actually went ahead and paid down $228 million of that debt.
Wow.
Yeah, they just decided, hey, let's reduce that debt load. So now they're sitting with a net cash position of $22 million. And that move, it should help lower their interest expense in 2025.
Smart move.
Yeah.
Okay, so that gives us, a decent overview of the financials. But there were some other things that came up during the earnings call that I think are worth digging into. Like, first off, there was this delay in filing their 10K.
Oh, yeah. That's always a little bit of a red flag, right? You never want to see a delayed filing.
Never a good sign.
Yeah.
So what happened there?
Well, it sounds like a couple of things went down. They found an error in how they were recognizing revenue for a $3.9 million shipment. Seems like they recorded it in Q2 of 2024 when the product went out the door. But because of some specific terms in that particular order, they should have actually recorded it in Q3 when the customer got it.
The joys of revenue recognition.
It's tricky stuff. It's tricky stuff. So yeah, they basically had a little miscommunication internally, which led to that error.
Okay, that's one thing. What else?
The other thing was, they had to reassess the goodwill associated with their AlphaZyme acquisition, and that took a little bit longer than they expected to finalize. And as a result, they had to take an $11.9 million non-cash charge for goodwill impairment.
Okay, so basically AlphaZyme wasn't worth as much as they thought it was.
Basically, yeah, the carrying value on their balance sheet was higher than its fair value.
Okay.
Not ideal, but, it happens.
It does happen. So these sound like some pretty, serious issues with their financial reporting. Should investors be worried?
Well, it's definitely something to keep in mind. Because of these problems, management came right out and said they haven't been maintaining effective internal controls. Yeah, they identified it as a material weakness in their internal control over financial reporting. And that can be a big deal. It means there's a higher chance of more financial misstatements in the future.
Yikes.
Yeah, and it means they're going to have to put in some serious work to fix those controls. But on the bright side, the 2024 financial statements did get an unqualified opinion from their auditors. So at least the errors, while they were a material weakness, didn't totally mess up the reliability of the overall financial statement.
Okay, that's somewhat reassuring, I guess. Now let's shift gears and talk about how each of their business segments performed, starting with NAP.
All right, so the NAP segment, that's the one with Trilink Research and AlphaZyme. They pulled in $42 million in revenue for Q4, and their adjusted EBITDA was $4 million. For the full year, revenue hit $196 million with an adjusted EBITDA of $51 million, which translates to a 26% margin. Not too shabby.
No, not bad at all.
And remember, that includes those $14 million in high-volume CleanCap sales in Q4 and $66 million for the whole year.
Right.
So that margin, it really shows that their nucleic acid production business is fundamentally profitable.
So who are the big customers driving that NAP revenue?
Well, if you look at the full year numbers, the majority of their NAP revenue, like 56%, came from bio-pharma companies.
Okay.
Then you've got life science and diagnostic companies. They make up about 32%. Then academia is 5%. And then CROs and CDMOs, they're just a tiny sliver at 1%. And then the last 6% is sales that go through distributors.
So really relying on those big biopharma companies.
Yeah, for sure. That's their bread and butter for the NAT business.
Gotcha. All right. Well, let's move on to the other segment then, BST. What was going on over there?
So BST, that's the one with the Cygnus business. They had a pretty solid quarter. Revenue was $15 million, and their adjusted EBITDA was $10 million.
Wow.
That's a 66% margin. Pretty impressive.
That's a huge margin. Yeah.
And for the full year, they brought in $63 million in revenue with an adjusted EBITDA of $44 million. So that bumps the margin up even higher to 70%.
Wow. So BST is really their profit powerhouse then.
Yeah, definitely. Much higher margins than the NAP segment.
So who are they selling all these safety testing products to?
Well, their customer base is a little bit more diverse than NAP. For 2024, biopharma made up 22% of their BST revenue.
Okay.
Life science and diagnostic companies, only about 3%. Academia, even smaller, just 1%. But CDMOs were a significant chink at 17%. And then get this, the biggest piece of the pie, 58% went through distributors.
Oh, that's a lot of distributors.
Yeah, so it seems like they're reaching a lot of customers through that channel.
Makes sense. So if you combine the profitability of both segments before you factor in all the corporate expenses, what kind of picture does that paint?
Well, if you add up the adjusted EBITDA from both segments before those corporate shared services expenses, you get a total of $95 million for 2024. And that's a combined margin of 37%. So even before you factor in the overhead, they're making a pretty decent profit.
That's a good sign.
Yeah, it is.
So what were those corporate shared service expenses looking like?
Well, they totaled $15 million in Q4 and $59 million for the entire year.
Yeah, okay.
But, the good news is that's actually down from what they were spending in 2023.
Really?
Yeah. They've been working on cutting costs, so it seems like those efforts are starting to pay off.
All right. Well, that's good to hear.
Yeah.
Now, I think everybody wants to know what's next. What did Maravai say about 2025? What are their expectations?
Right. Well, they're projecting that their base business revenue, so this is excluding any high volume CleanCap sales, will be somewhere between $185 million and $205 million.
Okay.
And if you take the midpoint of that range, it's basically low single digit growth. So I think they're being a little bit cautious in their outlook.
Yeah, that makes sense. But what about those high-volume CleanCap sales? Those were a big chunk of their revenue in the past. What are they expecting there?
Well, here's the thing. As of right now, they don't have any binding commitments for high-volume CleanCap demand in 2025.
Oh.
So they didn't include that potential revenue in their initial guidance.
That's a pretty big wild card then.
It is. But they did say they'll update their guidance if they get any firm commitments for high-volume CleanCap during the year.
Okay, so we'll have to wait and see.
Yeah, we'll have to keep an eye on that.
And did they say anything about their profit expectations for 2025?
Well, because of that uncertainty around the CleanCap revenue, they haven't given any specific adjusted EBITDA guidance yet.
Okay, so that makes it hard to predict what their bottom line will look like.
Yeah, it does. But they did give some guidance on other key expense categories.
Okay, what do they say?
They're expecting net interest expense to be between $14 million and $16 million, and that's after taking into account their recent debt paydown. Depreciation and amortization should fall somewhere between $50 million and $55 million. Equity-based compensation is projected to be in the range of $45 million to $50 million, and their weighted average diluted share count should be around 256 million shares.
All right, so at least we have some idea of what their expenses might look like. What about their capital expenditure plans? They've been investing a lot in expanding their facilities.
Right. Well, it looks like their capital expenditures are actually going to decrease quite a bit in 2025. They're projecting a range of $15 million to $20 million. And the biggest chunk of that, about $10 million, will be going towards expanding their enzyme manufacturing capabilities.
Okay.
They also said that their CapEx will be even lower in 2026, so it seems like they're finishing up that big facility expansion phase.
That makes sense. It can't go on forever.
Exactly.
So last question on guidance. Did they give any indication of how they expect the first quarter of 2025 to shape up?
Yeah, they did. They're estimating total revenue for Q1 2025 to be between $43 million and $45 million. So that gives us at least a short-term benchmark to track their progress.
All right, well, that's good to know. So moving beyond the numbers, what else did Maravai talk about during the earnings call?
Yeah.
What are their big strategic initiatives and how do they see the market evolving?
Well, they highlighted a bunch of strategic wins, like finishing those multi-year facility expansions, which should definitely improve their turnaround times. They also launched something like 50 new products over the year, and they made those acquisitions of A Fisani Bio and Molecular Assemblies in Q1 of 2025.
Right. Those were big moves.
Yeah. And they also talked about how their key partnerships are progressing and how those are helping them expand their reach.
Okay, so a lot of activity on the strategic front.
Yeah.
But what's their main focus going forward? Where are they really concentrating their efforts?
It sounds like their top priority for 2025 is growing their base business. And they're planning to do that in a few ways. First, they want to expand their product offerings, especially those focused on the discovery phase. Second, they're going to leverage those new GMP facilities in Flanders to offer more GMP-grade products and services. Third, they're going to focus on growing their AlphaZyme enzyme business. And finally, they want to keep expanding their Glen research portfolio of oligo products.
Okay, so a multi-pronged approach to growth. And those acquisitions they made, how do those fit into their overall strategy?
Well, they said those acquisitions, A Fisani Bio and Molecular Assemblies, are all about building a top-notch integrated platform for DNA and RNA design and discovery.
Okay.
Yeah, they want to create this seamless end-to-end solution for their customers who are designing and developing mRNA candidates. And A Fisani Bio brings a really cool AI-driven bioinformatics platform to the table.
So they're jumping on the AI bandwagon too.
Yeah, it seems like everyone is these days.
For sure. And they also mentioned some new partnerships, right? How are those going to help their business?
Well, they signed a pretty big European distribution agreement with VWR, and they added 11 new CleanCap supply agreements in 2024, bringing their total to 43. So those partnerships should definitely help them reach more customers.
Absolutely.
But here's another interesting thing. Their new CleanCap supply agreements actually require customers to disclose information about their IND and BLA filings. So that should give Maravai better visibility into how their customers' programs are progressing, which should help them with forecasting. And speaking of progress, they mentioned that 3 of their customers had their INDs or equivalent applications accepted in Q4. So that's a good sign that their customers are moving forward with their drug development programs.
Right. And it sounds like Maravai is trying to diversify their revenue streams beyond just that flagship CleanCap product.
Absolutely. They explicitly said that's a key focus for them. They want to build up that base business and not rely so heavily on bulk CleanCap sales.
Makes sense. So they're thinking long term.
Yeah, for sure. And to get a better handle on the market, they've even developed their own in-house clinical trial business intelligence platform.
Hell, that's impressive.
Yeah, it's pretty cool. They're tracking about 1,500 different mRNA and RNA-related drug candidates that are in development.
So what kind of insights are they getting from all that data?
Well, right now it looks like about 70% of those programs are still in preclinical development, while about 30% have moved into clinical trials. They estimate that their current CleanCap market share is around 30% for the clinical stage programs and about 40% for the discovery stage programs.
Interesting.
Yeah, and they also pointed out that there are currently 447 clinical mRNA programs out there. And the biggest disease target right now is cancer, accounting for 38% of those programs.
Wow, that's a lot of cancer research going on.
Yeah, it is. And here's another interesting tidbit. About 80% of the whole pipeline they're tracking is focused on non-infectious diseases.
Oh, really? So a big shift away from infectious diseases.
Yeah, it seems like that's where the industry is heading.
That's fascinating.
It is. And they also talked about their supply chain, which, has been a big issue for a lot of companies lately.
Right.
Well, they emphasize that over 95% of their raw materials are sourced right here in the U.S. So they're pretty well insulated from global supply chain disruptions.
That's a big advantage these days.
Yeah, definitely.
Okay, so what about their costs? What are they expecting in 2025?
Well, they said their cost structure for 2025 will probably be pretty similar to 2024. They're planning to contain costs in some areas, but they'll also be investing in commercial expansion and protecting their intellectual property. They estimate that about $200 million of their costs are fixed. And of course, their recent debt repayment should help lower their interest expenses.
Right. Smart move.
Yeah, definitely. They also mentioned that their interest rate cap expired in January 2025, and they didn't immediately renew it. So that could create some variability in their interest expenses, depending on what happens with interest rates in the market.
Okay, so a little bit of uncertainty there.
Yeah, but overall, they seem confident that their current cost structure will allow them to generate good margins as their business starts growing again.
All right, that's encouraging. Any final thoughts on Maravai before we move on to our This Is Not Financial Advices segment?
Sure, just a couple of things. They said they're still open to making more acquisitions, but they're going to be picky. They're looking for the right opportunities at the right price. And they hinted that any future deals will probably be smaller than some of their past acquisitions.
Yeah.
They also gave a quick update on their business in China, which is mostly in their BST segment. Revenue there was $13.6 million in 2024, and they're expecting it to stay pretty flat in 2025. Although they did mention there might be some shifts in business within the broader Asian region.
Interesting.
Yeah. And lastly, they highlighted a couple of positive trends. First, their customer concentration is decreasing. Their top 10 customers accounted for 46% of their revenue in 2024, down from 48% in 2023. Yeah, it shows they're diversifying their customer base. And second, they said they're seeing strong early traction with some of their new products, like CleanScribe.
All right, well, that's good news.
Yeah, it is. So Overall, I think Maravai is in a decent position. They've got some challenges to address, but they're also making progress on their strategic initiatives.
Absolutely. Okay, so now it's time for the part of the show where we put on our crazy speculator hats.
Let's do it.
This is not financial advice's segment.
All right.
And today we're going to come up with an outrageous, but, still kind of plausible trade idea based on what we've learned about Maravai.
Sounds fun.
Okay, so here's my thought. Maravai is really focused on growing their base business, right?
Right.
And there's a good chance that they could land some new high-volume CleanCap contracts in 2025, even though they haven't included that in their guidance yet.
Right.
So just what if, they announce a big new CleanCap deal in the next 6 to 9 months? That could be a huge catalyst for the stock.
Yeah, I mean, their current guidance is pretty cautious, so any positive surprise could really send the stock price soaring.
Exactly. So my outrageous but plausible trade idea is to go long on Maravai.
I like it. It's bold.
It is bold. But remember, this is all highly speculative. It depends entirely on what happens in the bio-pharma industry, which, as we know, can be very unpredictable.
Very true, very true.
So please do not take this as actual financial advice.
Definitely not.
Okay, do you have any other outrageous but plausible trade ideas?
I do. So we've talked about how profitable Maravai's Biologics safety testing segment is, right? Those margins are impressive.
Yeah, they really are.
And they could even gain more market share as biopharma projects potentially shift around geographically.
Interesting.
So here's my thought. A pairs trade. What if you go long on Maravai, specifically betting on the strength of their BST business, and at the same time, you short a competitor in the life science tool space, one that's maybe more exposed to the ups and downs of research funding, or that's heavily reliant on a specific therapeutic area that's not doing so well right now?
Okay, so you're basically betting that Maravai will outperform its peers.
Exactly. You're capitalizing on the relative strength of their safety testing business, but of course this is a much more complex strategy. It comes with its own risks, and you really need to do your homework on those comparable companies.
For sure.
But hey, it's outrageous, but plausible.
I like it. Well, that about wraps up our deep dive into Maravai LifeSciences. We've covered their financial performance, their strategic moves, and even thrown in some wild trade ideas for good measure.
Yeah, I think we've given our listeners a lot to think about.
But before we go, just a reminder that everything we've talked about today is purely for informational purposes. It's not financial advice. Please do your own research, consider your investment goals and risk tolerance, and consult with a financial professional before making any investment decisions.
Couldn't have said it better myself.
Thanks for listening to The Deep Dive. We'll be back soon with another in-depth look at an earnings call, helping you navigate the complex world of investing.